Sticking with the inflation debate, indicators from our next guest at Jefferies suggest we're about just a third to one half of the way through a bear steepening phase. Joining us is Sean Darby, our Chief Global Equity Strategist at Jefferies. So, Sean, does that suggest that inflationary expectations are going to continue to rise?
Well, if you actually look at the break-even curve in the United States, the two-year inflation expectations are still well above 10 years. So we're still for 24 months of pretty difficult inflation data. And you should also be aware that actually inflation surprises are still well above those being forecast by the market pundits. So the difficulty at the moment is not just the Fed doesn't perhaps see how these prices are going to develop, but also the market's finding it very difficult to actually forecast them. So unfortunately, I think at least for the next 12 to 18 months, we're going to be living in a period of heightened inflation pressures. And that's also was revealed by the Beige Book as well this week, where the majority of the respondents pointed out that they felt that the inflation wasn't going to be transitory, as perhaps the Fed alludes to.
That's part of that's a big part of the issue, right? Because even Jay Powell himself says that this is a very unusual, unique type of inflation that we have because of the structural, I guess, distortions of this being pandemic related and us never being here before. As an investor, how do you hedge, or do you hedge against that uncertainty?
Well, it would be a nightmare if the Federal Reserve chose to drop the average inflation targeting and then prematurely raise rates or indicate that they were going to raise rates at this point, because certainly for equity markets, they've not priced that in at all. And other asset classes would also reflect a pretty heightened level of volatility. And that sort of scenario is not priced in either the dollar or in equity markets, I believe. For our perspective, the good news is that corporate profits, that's both the sales number and the nominal sort of inflation number, is actually very, very high. So actually companies are developing some of the best profits we've seen over the last 30 years. So in a sense, we're not necessarily running on hot air, but they're running on a very, very elevated level of profit. So the good news is, at least for the next 12 months, I don't think the profit cycle is going to pull the rug under the feet from the equity investors. So we're still quite bullish on the banks, cyclicals, energy and materials, and generally feel that it's still a reasonable environment for equity markets to outperform other asset classes.
Sean, what about big tech? Because this GTV chart on the Bloomberg shows how really their market cap continues to swell. And of course, we know that they're raking in the profits.
So the FANG stocks plus Microsoft account for around about 25% of S&P 500. They tend to be perfectly inversely correlated to the US 10-year Treasury, so they've done very well in the last 24 months. They're perennially getting earnings upgrades, which again is very much a feature of their business models. From my point of view, their starting point in this cycle is that the hurdle rate on their profits is already quite high, and secondly, the valuation starting point is also quite difficult as well. So I think you've still got a lot more population of stocks out there outside of the big tech stocks, which are less overvalued. Two other things just to highlight. Over the last 7 days, you have had the reinforcement of antitrust measures by President Biden, and of course the G20 signing up to the minimum corporate tax rate of 15%, and that would be, both of those elements would be difficult for the FANG plus Microsoft in the longer term.
Sean, just quickly, if we get more profits for perhaps not only big tech but other sectors, does that mean that they will be reinvesting those profits? Could we expect CapEx plans to expand?
So yes, I think possibly the one thing that is a sort of benevolent cycle is the animal spirits have risen much faster than we saw during the post the GFC. CapEx could be 2 or 3 times higher than anything that we've seen in the last 20 years. And you should also bear in mind that companies, including the banks, are doing an enormous amount of share buybacks. So that profit recycling won't just go into CapEx. It's also, as we're seeing through the financials, going into share buybacks and increased dividends as well.